Welcome to Module 18. In Module 18 of Accounting 5000, we're going to cover the first part of Chapter 9. The first part of Chapter 9 deals with the income statement. The second part of Chapter 9 will deal with the cash flow statement, and we'll do that in Module 19. So let's start talking about the income statement. The income statement has two basic parts, revenues and expenses. And as an investor or a creditor, you're going to be looking at this income statement and asking yourself such questions as, how much did profit go up? Or perhaps there was a loss. Why was there a loss? Was it because sales went up or down, or was it because of cost of goods sold changing? One of the terms that you hear a lot in the business world is the bottom line. We're always trying to get down to the bottom line. The bottom line in accounting is net income. And that's the bottom line in most financial analysis. What is net income? That's the basic question. If you look in your textbook on page 309, you will see there's a good example of what an income statement looks like. In this case, this is Intel Corporation's income statement, and it shows you comparative numbers for 3 years. So you may want to refer to that back and forth as we go through and talk about the different elements that are on this income statement. Let's talk first about the top part of the income statement, which is your revenue section. Revenues are defined as inflows of assets that result from major operations. These operations occur in your what we call normal course of business. So if you're a McDonald's, you are showing revenues based on your sales of hamburgers and fries and other things that you sell in the fast food area. Sales would not include such things as land which they had purchased and no longer needed, or buildings that they sold, or any vehicles or machinery. It only includes those items that they sell in their normal course of business, their major operations. In order for a company to actually put this revenue on their books, two things have to occur. The revenue has to be realized, and the revenue has to be earned. And it's usually a fairly straightforward type of determination. To be realized, revenue has to either be able to be cash at the present time or will become cash in the near future. For example, as we're talking about McDonald's, if you go and purchase a hamburger or a Coke or something, you give them cash at that point. So the revenue has been realized. They actually have the cash in their hand. On the other hand, if you go to a major retailer, say Penny's or Sears or Profits, and you purchase something on credit, it's still realized because the company has the hopes of receiving cash in the very near future. So it has been realized. The earned part of that requirement is that the substantial process of earning that income has been completed. In other words, McDonald's has given you the food you wanted, or the retailer has given you the goods that you purchased. So that's, like we said, fairly straightforward because you can usually tell whether you've gotten the money or will have a promise of the money, and that you've done everything you need to do to earn that money. Well, on your income statement, that revenue shows up in a revenue section, the very top part of the income statement, and there are some components that you need to be aware of. Under the revenue section, every company will start it with what they call sales. And again, that's the stuff that comes about from their normal course of business. Deducted from sales are two items, sales returns and allowances, and cash discounts, sometimes called sales discounts. If you subtract from sales those two items, you receive what we call net sales. So that will be the top part. Sales returns and allowances, though, is a little bit different from what you may think. Sales returns are when people buy an item and then take it back to the store to get a refund on it. Those are sales returns. Probably very familiar with that right after Christmas. I believe the day after Christmas is one of the busiest times for sales returns. People have received gifts. They either have 2 or 3 of them or they don't want them, so they take them back to the store and get a refund. Those are sales returns. Sales allowances occur when a company makes a sale and the customer finds a slight defect or something wrong with the product, and rather than exchanging it for cash, they get a discount on the price. That's a sales discount or a sales allowance. The cash discount results from paying early. And remember, in the previous module, we talked about the terms 210 N30 or 110 N60. If a customer takes that discount and pays promptly, then that discount shows up here as cash discounts. So that summary will give you net sales. That's the top part of your income statement. The next part of your income statement would be expenses. And under expenses, what you will have are major outflows from major operations. And again, this is in the normal course of a company's business. They will be such things as the hamburger and bread and condiments that they put on the hamburgers at McDonald's. They will be such things as the rent and utilities that are incurred by any retail operation. So it's all the outflows that you have to incur in your normal course of business. Again, it's not selling land if you're a fast food dealer. If you think back to Module 2, we talked about the matching principle. Expenses are based on the matching principle. We match to the revenues we earned all the costs that we incurred to earn those revenues. So we're matching revenues and expenses. If you look down through a number of companies' income statements, you will see a wide variety of expenses. Such things as wages expense, utilities expense. There are a number of them. Be aware that anything has expense after it is going to be a deduction from the revenue. One of the major types of expenses that you'll see on an income statement is called cost of goods sold. Cost of goods sold is the cost of the product that the company is selling. It can either be a merchandiser who has purchased goods and is reselling them, or it can be a manufacturing firm that is selling things that they have produced. We'll discuss cost of goods sold in more detail in just a minute, but a couple of other examples of expenses are selling, general, and administrative expenses, research and development expenses, often called R&D, taxes, and interest. And the taxes and interest will show up in a different segment of the income statement from the previous expenses. So we'll discuss the format of the income statement in just a minute too. But one of the most important things you need to take out of this part of the chapter is how to compute cost of goods sold. This will be something that you will need to know for this course. You'll need to know it for any business operations and for your future as a business person. Learn this formula. Cost of goods sold is computed by taking your beginning inventory. In other words, whatever you had in inventory at the beginning of the year. You add to that all the stuff that you've purchased during the year, what we call net purchases. Those two things tell you what was available for sale. That abbreviation stands for cost of goods available for sale. If those goods were available to sell, they're either sold or they're still there. So the easiest thing to do is go in at the end of the year and count and see what your ending inventory is, and whatever is not in your ending inventory was sold. So that would be your cost of goods sold. The one thing to remember is that the dollar amounts we put on these different items that are listed on that slide depends on which cost flow assumption we use for inventory, whether we use FIFO, LIFO, or weighted average, specific identification. So be aware that may change depending upon which method we use. In computing cost of goods sold, you often have to compute purchases. And remember that purchases consist of not only all the stuff that you bought, but the cost of getting the stuff you bought to your place of business. It will include such things as freight in other words, the cost of getting it there. Any insurance you had to incur to get it to your place of business. If you got the ability to take discounts on those purchases, in other words, you paid early or you had some refunds, you subtract those out just like you did with the other side of the equation when you were actually selling the stuff. You may have discounts or returns and allowances. So on the slide you see right there, that is the computation for purchases. Net purchases will be the result of your gross purchases plus the freight and insurance to get it there minus any discounts, returns, or allowances. Let's talk a little bit about the format of the income statement then. There's some good examples in your book of the various formats, not just the one that's on page 309, but a few others. And as we go through this discussion, I'll point those out to you. In the first part of the statement, you will have your sales number. Then you will have a deduction for cost of goods sold. So it'll be sales minus cost of goods sold. And that will give you something that we call gross profit. You may also hear it called gross margin. This can be done in dollars or in percents. And if you look in your book on page 319 at the very top of the page, there's a brief little box that shows you how to compute gross profit and gross profit percentage. But all it is sales minus cost of goods sold. Moving down the income statement then, the next category of expenses you have are your operating expenses. These are such things as your selling, general and administrative expenses, your research and development expenses. This section of the income statement will give you a picture of management's ability to actually use their resources to produce sales. Again, a good example of that is on page 321 of your textbook. About the bottom of the page, they show you the middle part of the income statement with a focus on the income from operations section. So you have your gross profit section, which is sales minus cost of goods sold. Then you have this section, income from operations. And then you have a line we call income before taxes. We highlight our tax expense by deducting then taxes, and that gives us net income. At the very bottom of the income statement, you will see the term EPS, or earnings per share. This tells an investor or a creditor exactly how much income each share of stock earned. And that's computed one of two ways. If all a company has is common stock, and there are no convertible options like preferred stock that converted to be common stock or bonds that could be converted to common stock, then we just have what we call basic earnings per share. To compute the basic earnings per share, you use that third bullet that's on the slide in front of you. You take net income, subtract out your preferred dividends, and you divide it by your weighted average number of shares of common stock. On page 323 of your textbook, there's a good example at the very bottom of the page of the computation of basic earnings per share. The only time you will be doing diluted earnings per share would be if you had some what we call convertible securities. If you had preferred stock or bonds that could be converted to common stock, then you'll want to go through and pretend that they were converted and see what the earnings per share would have been at that point. In this course, we're not going to spend a lot of time with diluted earnings per share. We're going to focus on basic earnings per share so that we'll be able to tell how much each share of stock earned. Further in your book on page 326, they have two examples of income statements. One is called a single-step income statement, and then right under that, continuing on to page 327, is a multiple-step income statement. You will notice that in the single-step income statement, all you're doing is taking cost of goods sold, subtracting it from sales, getting some expenses, listing all your general and administrative expenses, and eventually coming up with net income. Compare that information that you get with the one that you get below there, the multiple-step format, where you have sales minus cost of goods sold, giving you gross profit, then deducting your general, what we call other expenses, getting income from operations, then your interest expense, then your taxes, then net income. You get more information on the multiple-step format than you do on the single-step format. There's a lot more information involved in computing gross profit and income from operations. Now you could do that with the single-step format, but it leaves a lot for the investor and creditor to compute for him or herself. So it's much easier for other people to use the multiple-step format. But most of the time, what you'll see in published financial reports will be the single-step income statement, simply because it's easier, neater, and they allow that most investors and creditors can easily compute those items for themselves. The one thing that you may notice at the very bottom of some income statements are what we call unusual items. You don't always see this, and occasionally they're on there, but they're in a special order. We have what we call income from discontinued operations, extraordinary items, the effect of any minority interest. Remember, we talked about minority interest previously. And then finally, the cumulative effect of change in accounting principle. Discontinued operations occurs when a company has decided to discontinue a major part of their company, something that would stand alone if it were able to do so. Not just a piece of the company, but a major component. Extraordinary items will occur when an unusual event, an infrequent event occurs. It has to meet certain criteria from an accounting standpoint to be included as an extraordinary item. Minority interest, as we said earlier, is when a company owns, say, 90% of a firm, but the other 10% is owned by other outside parties. Those are called minority shareholders. We show their information separately. And finally, the last thing we would show would be a change in accounting principle. If a company changes from, say, LIFO to FIFO or from certain different kinds of accounting treatments, this is disclosed separately on the income statement at the very bottom. So they're shown in order if they occur. They're very unusual events, and they have to meet certain criteria from an accounting standpoint to be included. In many cases, investors and creditors tend to ignore these unusual items because they don't have an effect on the continuing operations of the business. In other words, they're looking at income from continuing operations over time. They're looking for trends. These unusual items don't have an impact on the trend of the company. So most investors and creditors look at them, consider them, look at the earnings per share impact of those items, but don't really put them in their trend analysis. Okay, let's practice a little bit then on what we've learned today, and let's begin by looking at exercise 9.1. 9.1 is in your textbook on page 340, right about the middle of the page. You have a university that has a fiscal year end that ends the end of June. Their summer session of the university runs from June 9th to July 28th, so it's running over that break point for their fiscal year. Total tuition paid by students for the summer session amounted to $112,000. They ask you in Part A how much revenue should be reflected in the fiscal year that ends June 30th, 2004. Well, part of that revenue will be earned in 2004. Part of it will be earned in the next year because the semester break occurs after the year end. So the year is going to end in the middle of their semester. So part of the revenue will be earned in one year and part in another. In order to figure out how much goes where, we take the total number of days that are going to be in that summer session. So we take all the days in June, which is 22, and all the days in July, which is 28, and that gives us a total of 50 days. So up until the end of June, they will earn 22 over 50 of their revenue, and the next year they will earn the remainder, the 28 over 50. So for 2004, they'll earn 22 over 50 times $112,000, which is $48,000. In Part B, they ask you, would your answer to A be any different if the university had a tuition refund policy that stated no tuition would be refunded after the end of the third week of the summer session? The answer is no, because your event there is offering the classes. You don't care about the refund policy. It's sort of like the sales and sales return. We don't care about the return policy. We're looking at the event of offering the classes and generating the revenue from the offering of the classes. Exercise 2 follows along with that theme a little bit. Let's look at it. You have a theater that sells season tickets for 6 events at a price of $84. In pricing the tickets, the planner assigned the lead-off event a value of $20 because it incurred more expenses. The last 5 events were priced equally, and they sold 1,200 season tickets. They ask you to calculate their earned revenue after the first 3 events. Well, their first 3 events, I've skipped ahead too many slides here. The first event, we said we had a $20 value on it. So we take $20 times the 1,200 people who bought tickets. So $20 times 1,200. If I can get the slide to move forward. Is $24,000. Now we have to figure out what the rest of the events are worth. It doesn't tell us a dollar amount for the remaining events. It just says that all of the last 5 events are equally priced. So if we have $84 and we subtract out $20, that gives us $64 we need to divide up over 5 events. So if you divide 64 by 5, you get $12.80. So each of the next events has a revenue of $12.80 per ticket times the 1,200 tickets. You add that up, you get $54,720. Then in Part B it says about 95% of the season ticket holders attended the first event. Subsequent events were only attended by about 80% of the season ticket holders. What extent, if any, should the attendance data impact revenue recognition? Again, it shouldn't impact your recognition of revenue at all because the critical event is offering those performances. It's not who attends. That doesn't impact. Did you perform? You've already sold the tickets, so it's not important who attends. Let's look a little bit at gross profit then. We talked earlier about the fact that sales minus cost of goods sold gives you gross profit. Well, in problem 5 on page 341, they ask you to calculate gross profit ratio for each of the past 3 years for Intel Corporation. Well, you have to look through your book to find the Intel Corporation income statement. It's in the appendix of your textbook on page 633. And what you see there would be a list of the different revenues for 3 years, the cost of goods sold for 3 years, the gross profit for 3 years, and using that information, you can compute the gross profit percent. If you look on the slide that I have in front of you, I've copied that information down from the annual report of Intel for 1999, 2000, and 2001. I've simply gone through and brought in all of the data that's listed there for you, and I've computed the gross profit percent. Now you will notice that the gross profit percent has changed significantly over time. In 1999 it was 59.7%. That meant that of every dollar in sales, 59.7% of that dollar, in other words a little over 59 cents, could go to cover their operating expenses and profit. But that dropped over time. Until 2001 it was 49.2%. So that for every dollar in sales, only 49 cents was able to cover their net income and operating profit. In Part B it says, okay, now assume that for the first 4 months of 2002 they had $12.6 billion in revenues. What would be their gross profit? Well, if we use the gross profit percentage that we had from 2001, which was 49.2, we know that 49.2% of $12,600 is $6,199 million. So we could use this information from the past to help us predict for the future. One thing to realize from this example, the one that's on the screen right here, revenue is always 100%. Cost of goods sold is simply a percentage of revenue, so in this case it would be 64.01 divided by 12,600, that would give you 50.8%. Gross profit is simply 61.99 divided by 12,600, or 49.2%. These 2%, the cost of goods sold and gross profit, have to total to 100%. Revenue is always 100%. Let's look at one more problem. Let's look over at problem 10 in your textbook. Problem 10 tells that you have a company called Thrifty Company that reported net income of $745,000 for its fiscal year end January 31, 2004. At the beginning of the year, 240,000 shares of common stock were outstanding, and in October 2003 they had an additional 40,000 shares that were issued. There were no other changes. During the year they paid dividends on 30,000 shares of 5%, 40% preferred stock. These were outstanding all during the year. They ask you to compute basic earnings per share. Basic earnings per share is simply net income minus preferred dividends divided by the weighted average number of shares of stock. So the first thing we have to do is compute the weighted average number of shares of stock. In order to do that, you take the number of shares of stock you had at the beginning of the year and multiply it by how many months out of the year that number was outstanding. Well, that was outstanding from the end of January until the end of October. That's 9 months. So you multiply that by 9/12. You then sold 40,000 more shares, so you now have 280,000 shares, and those were outstanding from the end of October till the end of January, which is 3 months. You take your 180 resulting plus 70,000 resulting, and you get 250,000 as your ending weighted average number of shares of stock. Now you need to compute your preferred dividend. You take the number of shares of preferred stock times the par value times the percent of dividend, which is 5%. You're going to pay preferred dividends of $60,000. Now, you have all the information you need to compute your basic earnings per share. You have net income of $745,000 that was given to you. You can subtract out your preferred dividends of $60,000 that you just computed. And you're going to divide that by your weighted average number of shares of common stock, which you computed just a second ago as being 250,000 shares. And that gives you $2.74 as your earnings per share. That tells you that each share of stock earned $2.74. In Part B of this problem, they ask you what would happen if this company's preferred stock was convertible into common stock. In that case, you would have to compute your diluted earnings per share. You would have to pretend that all of those preferred stocks had been converted into common stock. That would change your weighted average number of shares of common stock. It would also change your dividend preferred because you would not be paying preferred dividends. And it would change your earnings per share calculation. The final problem in this section is problem 18. I'm not going to spend a lot of time going over it, but I do want to get you started on it, and this is one you can work on your own. What they want you to do in problem 18 is to actually construct an income statement. Now, as I've said as we've gone along this chapter, there are several examples of income statements in your textbook, and the answers are here in your slides, which you can download, or have downloaded, I hope. And so I'm going to give you some head starts on this, and then kind of talk a little bit about the things that may confuse you. What you have is a company that has a bunch of information there in the purple box, and they first ask you to calculate operating income. Well, if you think back about your income statement, you're going to start with sales. You're going to subtract out cost of goods sold. You're going to get gross profit. You're going to subtract out then your selling, general, and administrative expenses and your R&D expenses. That will give you operating income. Then they ask you to compute net income, and in order to do that, you're going to have to subtract out your other information. First, your interest expense, then your tax expense, and then those unusual items, discontinued operations, extraordinary gains. That will then give you your net income, and you will need to go through that problem and look at the items that are in the purple box and decide which section of the income statement they go on. Be aware, though, they've thrown some ringers in there on you. For example, they have included accounts payable. That doesn't go in there. That's a balance sheet account. So you're only going to use the information that goes on an income statement. So be careful as you work through that problem and pick up the right pieces of information for your income statement. In the next module, we'll continue this chapter and we'll look at the statement of cash flows.